I want to bring in Tom Lee. He's the Chief U.S. Equity Strategist at JPMorgan. Tom, good to have you join us again. And, you know, earlier this morning, or in the last hour, I should say, we were talking to Wilbur Ross, and he was pretty sanguine about how big of an impact this quake is going to have in terms of the economy, in terms of the recovery. What is your take?
I think Wilbur's right. You know, we got a note from our Japanese economist on this, and, you know, his estimates for quake damage are pretty small. I think if there was sort of
what are
risk, it was sort of the $1 to $2 billion was sort of his initial cut of the estimates. But
okay.
You know, if we sort of think about this, I mean, this is not going to trigger political instability in any region. You know, it's not hitting any sort of base or soft commodity exporter. So it's really sort of an end market in terms of where products are sold. So I do think this is not going to be a big deal for U.S. equities or U.S. economy.
So it's not going to spark that correction, Tom, that I know you've been looking for, right?
That's right. You know, I mean, Betty, if we had to sort of guess the best suspect for a correction, it would be another standard deviation move in oil would be the biggest risk, I think, behind a correction and the associated earnings reductions. But you know, March has not been a good month for stocks, and you know what we're kind of thinking about is, you know, active managers and hedge funds have barely been trailing year to date. So, you know, we're just still thinking they're going to use March as an opportunity to buy.
So they're going to, okay, so they're still going to be buying. That's offsetting any selling pressure then based on what we have seen, Tom, so far, which has been that spike in oil. So when you say standard deviation in oil, what are we talking about to spark that correction you're talking about?
Well, so we've had about a $20 move since November. That's a 2 standard deviation move. It's only happened 5 times in the last 10 years. If it's for 30 days, which it's been 30 days so far, it is usually enough for 5 or 6 S&P industries to actually have to cut estimates. You know, this is autos, airlines, household durables. I think that's where we're going to see some damage after just 30 days. But, you know, 30 days is only 20 cents to S&P earnings overall. So it really means you got to have oil at this level for a full year to really hurt earnings, or for it to move another 20 points, and then we're suddenly doubling the damage rate. Okay,
so let me get this straight. So you need to have oil at what level then to start a correction? At what level are you talking about?
I think it's the one on WTI, more in that 120, 140 range.
Okay.
And then, you know, when you get to 150, I think we really start talking recession.
A double dip recession then?
Correct. Yes.
Okay, but that's not in your forecast right now.
No. In fact, our oil strategist actually thinks you keep political tensions elevated here, you know, and assumes Saudi regime remains in control. He thinks we're in the mid-90s by the summer.
Mid-90s by the summer. Okay.
Yeah.
What about? Okay. So, and the correction then, Tom, is going to still be 7 to 8%. Is that what you?
That's right.
Forecast?
Correct. You know, so it's a move to 1250. You know, I think that the question people are probably asking right now, because of the volatility, is, you know, why not 10 to 15%? You know, we actually published a piece this morning. You know, if you look at all bull markets, and there's really sort of 14 you can count, in those 14 bull markets, you've never had 2 10% corrections
okay.
in the same bull market.